The Williams-Cent-R indicator is calculated using a specific formula that compares the current closing price to the high-low range over a specified time period. The formula is Cent-R equals the highest high minus close divided by the highest high minus lowest low multiplied by negative 100. Let's break down each component of this formula to understand how it works. The highest high refers to the maximum price reached during the look-back period, which is typically set to 14 periods. The lowest low is the minimum price during the same look-back period. The close refers to the most recent closing price at the time of calculation. Finally, we multiply by negative 100. This inverts and scales the indicator to range from 0 to negative 100. Let's see how this works with a visual example. Here's a sample price chart showing highs, lows, and closing prices over 14 periods. For our calculation example, we'll use the data from this chart. In our 14-period sample, the highest high is 90, the lowest low is 60, and the most recent closing price is 82. We apply the Williams-Cent-R formula. The highest high 90 minus the closing price 82, divided by the highest high 90 minus the lowest low 60, multiplied by negative 100. This gives us 8 divided by 30, multiplied by negative 100, resulting in a Williams-Cent-R value of negative 26.67. The Williams-Cent-R indicator produces values ranging from 0 to negative 100. Let's see where our calculated value falls on this scale. As prices move higher, the Williams-Cent-R value becomes more negative, moving toward negative 100. Conversely, as prices fall, the indicator moves toward 0. Although 14 periods is the standard look-back setting for Williams-Cent-R, this timeframe can be adjusted based on trading preferences and strategies. The Williams-Cent-R indicator ranges from 0 to minus 100 with 3 key zones that traders monitor. When the indicator reads between 0 and minus 20, it suggests the market is overbought, potentially signaling a selling opportunity. The middle range between minus 20 and minus 80 is generally considered neutral territory for the indicator. When the indicator reads between negative 80 and negative 100, it suggests the market is oversold, potentially signaling a buying opportunity. Let's look at how the Williams-Cent-R indicator moves through these zones on a chart. As price action develops, the Williams-Cent-R oscillates between the overbought and oversold zones. One unique aspect of Williams-Cent-R is that it's inverted compared to many other oscillators. Higher values, closer to 0, indicate stronger upward momentum, while lower values, closer to negative 100, indicate stronger downward momentum. Remember, the key zones are overbought from 0 to minus 20, neutral from minus 20 to minus 80, and oversold from minus 80 to minus 100. Identifying overbought conditions is crucial for timing potential exits from a trade. An overbought condition occurs when the Williams-Cent-R indicator moves above negative 20 and approaches 0. On the Williams-Cent-R scale, the overbought zone is represented by the region between negative 20 and 0. When the price has been rising strongly, the Williams-Cent-R indicator will move into this overbought territory, suggesting a potential pullback or reversal. It's important to understand that during strong uptrends, the Williams-Cent-R indicator can remain in overbought territory for extended periods. Rather than simply entering a trade when the overbought threshold is reached, traders often look for the indicator to cross back below negative 20 as a potential sell signal. For more reliable trading decisions, it's recommended to combine Williams-Cent-R with other technical indicators for confirmation of potential reversals. To summarize, identifying overbought conditions with Williams-Cent-R helps traders spot potential reversal points, but it's important to wait for confirmation rather than acting on the initial signal alone. Let's examine how to identify oversold conditions using the Williams-Cent-R indicator. When the Williams-Cent-R indicator moves below negative 80 and approaches negative 100, it indicates an oversold condition. This typically occurs when prices have been falling strongly, suggesting the asset has been heavily sold and might be due for a bounce or reversal. When price enters a strong downtrend, Williams-Cent-R can plunge below negative 80, often reaching values near negative 100. A key insight is that during strong downtrends, Williams-Cent-R can remain in oversold territory for extended periods. That's why experienced traders typically wait for the indicator to cross back above -80 as a potential buy signal, rather than simply entering when the oversold threshold is first reached. Remember that oversold does not automatically mean buy. The indicator can remain oversold during prolonged downtrends, making patience crucial. Next, we'll look at how to identify divergent signals using the Williams-Cent-R indicator. Let's explore failure swings in Williams-Cent-R, which are powerful patterns for identifying momentum shifts. A bullish failure swing can indicate strengthening upward momentum. The bullish pattern begins when Williams-Cent-R falls into the oversold region below -80. Next, the indicator rises above the -80 threshold, showing initial bullish momentum. Then it pulls back, but critically, it stays above the -80 level, indicating that sellers no longer have enough momentum to push prices back to previous lows. Finally, the indicator rises again, confirming the strengthening bullish momentum. A bearish failure swing, on the other hand, indicates strengthening downward momentum. The bearish pattern begins when Williams-Cent-R rises into the overbought region above -20. Then the indicator falls below the -20 threshold, showing initial bearish momentum. Next, it rallies, but importantly, it stays below the -20 level, indicating that buyers don't have enough strength to push prices back to previous highs. Finally, the indicator falls again, confirming the strengthening bearish momentum. Let's examine why failure swings are valuable patterns for traders. Failure swings provide earlier signals than simply waiting for the Williams-Cent-R to cross the overbought or oversold thresholds. They indicate strengthening momentum in a particular direction, giving traders confidence in potential trend continuations. These patterns can help confirm potential trend reversals when they align with other technical signals. Most importantly, failure swings allow traders to time their entries or exits more precisely. Let's compare traditional Williams-Cent-R signals with failure swing patterns. With a traditional approach, traders wait for the indicator to cross back above -80 from the oversold region to generate a buy signal. However, failure swings can provide earlier signals by identifying changes in momentum before the indicator crosses the threshold. In summary, failure swings in Williams-Cent-R offer traders a way to detect momentum shifts earlier, potentially improving trade timing and profitability. When using Williams-Cent-R, an important consideration is the timeframe setting. The standard setting for Williams-Cent-R is 14 periods, but this can be adjusted based on your trading style and objectives. Shorter timeframes, like 7 periods, make the indicator more sensitive to price changes. This increased sensitivity generates more trading signals, but also produces more false positives, potentially leading to overtrading. Longer timeframes, such as 21 periods, make the indicator less sensitive to price fluctuations. This reduced sensitivity generates fewer signals, but they tend to be more reliable, with the trade-off of potentially missing some opportunities. Let's compare the characteristics of different timeframe settings. When selecting a timeframe for Williams-Cent-R, there are several key points to consider. Ultimately, traders should align the indicator's timeframe with their trading horizon, shorter for day trading, longer for swing or position trading. Williams-Cent-R works best when combined with other technical analysis tools. Trend indicators like moving averages can help filter signals, only taking buy signals in uptrends and sell signals in downtrends. Volume indicators can confirm the strength of moves indicated by Williams-Cent-R. Higher volume adds confidence to potential reversals. Support and resistance levels provide additional context for overbought and oversold readings. Reversals near these levels are often more reliable. Using Williams-Cent-R as part of a comprehensive trading system rather than in isolation typically yields better results. By combining Williams-Cent-R with multiple confirmation indicators, traders can develop more reliable trading strategies. 4 effective trading strategies can be implemented using the Williams-Cent-R indicator. The reversal strategy involves taking trades when the Williams Cent R crosses back from oversold or overbought territories. This strategy works best during trending markets and can signal the resumption of the primary trend after a pullback. The confirmation strategy uses Williams Cent R to confirm signals from other indicators. For example, a bullish MA crossover becomes more reliable when Williams Cent R is moving up from oversold territory. This approach creates higher probability setups by requiring multiple conditions to align. The divergence strategy looks for misalignments between price movements and indicator behavior. A bearish divergence occurs when price makes higher highs while Williams Cent R makes lower highs, suggesting weakening momentum. Conversely, a bullish divergence appears when price makes lower lows while Williams Cent R makes higher lows. The range-bound strategy takes advantage of oscillations between overbought and oversold levels during sideways markets. Traders sell when the indicator reaches overbought territory near -20 and buy when it reaches oversold territory near -80. This strategy performs best in non-trending, consolidating market conditions. Regardless of which Williams Cent R strategy you implement, proper risk management is essential. Always use stop losses to protect your capital. Backtest each strategy thoroughly before applying it to real markets. Consider using multiple timeframes for confirmation and start with small position sizes while you refine your approach. Finally, continuously monitor your win rate and risk-reward ratio to ensure your strategy remains effective.